The opening range breakout is a staple for day traders, but it is also one of the fastest ways to lose capital. If you jump in at the first sign of a boundary break, you often find yourself caught in an immediate reversal. This happens because of a liquidity trap. Standard breakouts lure retail traders into buying at highs, placing their stop losses just below the breakout candle. The market then sweeps back down to hunt those stops, using that forced selling to fuel a move in the opposite direction. To avoid this, we use a mechanical variation of the ORB. By identifying specific institutional footprints, we can target a consistent 2-to-1 reward on our trades, while letting the fakeouts pass us by. Setting up your NASDAQ chart for the 9:30 a.m. New York Open is only the first step. To stay on the right side of the trade, you need to recognize how the smart money actually enters the market. Step 1 requires the 15-minute time frame. When the market opens at 9:30 a.m., sit on your hands. You need to wait for that very first 15-minute candle to fully form and close at 9:45. Once that candle closes, draw horizontal lines at the exact high and the exact low of the range. This creates your opening range box, the boundaries for the rest of our analysis. Now drop down to the 5-minute time frame. We are looking for price action to break out of this box, but we aren't just looking for a candle to close outside the line. A valid breakout must be backed by a fair value gap, or FVG. This is our primary filter to distinguish between a weak push and a significant move. A fair value gap is a 3-candle sequence. We need to see a gap where the high of the first candle and the low of the third candle do not touch. The middle candle in the sequence must be the one that actually displaces through our 15-minute boundary. If the wicks of the surrounding candles overlap and fill that space, the breakout lacks the necessary volume and is considered invalid. In that case, we don't take the trade. This gap represents displacement. It is the visual evidence of institutional buyers entering with enough force to create an imbalance, which is a much more reliable signal than a simple price poke. Even when you see a perfect breakout with a gap, do not hit the buy button yet. Most traders fail by chasing the price. We wait for the retest. This is a mandatory cooling off period where price pulls back toward the range it just broke. We want to see price action descend back into that shaded FVG zone and physically tap the original 15-minute boundary line. This pullback often scares retail traders who bought the high, forcing them to exit. Their panic provides the liquidity that smart money uses to fill orders at a better price. Once the price is inside our zone, we look for the final trigger, the engulfing candlestick. The next 5-minute candle must aggressively reject the boundary line and close with a body that completely engulfs the previous retest candle. Entry is strictly forbidden until this candle closes. A mere touch of the line is not a signal. The close provides the confirmation that the buyers have regained control. Combining the FVG retest with the engulfing close filters out the noise. It ensures you only enter when the initial trap has cleared and the original momentum is returning. Now that the pattern has been confirmed, we can set our exact entry, stop loss, and target. Set your entry at the exact close of the engulfing confirmation candle. Place your stop loss slightly below the swing low of the retest sequence. This area should not be revisited if our analysis of institutional momentum is correct. For your target, look for a 2R return. This means your potential profit is exactly double the amount you are risking on the trade. As the trade plays out, the price should run away from the entry point and reach the 2R target without returning to the stop loss. Following a strict 2R profit plan protects your capital. It ensures that your winning trades significantly outweigh your losses, making the strategy sustainable over time. This completed setup shows how the 15-minute lines, the FVG displacement, and the engulfing trigger work together to create a high-probability entry point. Following these mechanical steps prevents you from becoming the liquidity that larger players use to fuel their moves. Open your charts and look at the last few days of NASDAQ price action. Apply these 5 steps and see how many retail traps you would have avoided by waiting for this specific confirmation. Successful results come from executing this 5-step mechanical sequence without deviation. By waiting for the market to reveal its hand, you trade with a confirmed edge.